Have you ever wondered what makes Warren Buffett, one of the richest men in the world, so successful in the stock market? This man, hailing from Omaha, Nebraska, has built an empire of wealth that most of us can only dream of. He's not a wizard or a magician. He's Warren Buffett, also known as the Oracle of Omaha. Warren Buffett's name is synonymous with success in the world of investing. He's revered, respected, and studied by those seeking to understand the secret of his success. Before moving on, make sure to hit the like button, comment, "I will attract money in abundance," and subscribe to our channel so that you don't miss out on amazing content in the world of investing. Buffett's investment strategies have stood the test of time, weathered numerous economic storms, and consistently delivered impressive returns. His approach to investing is not about quick wins or chasing the latest trends. It's about principles, patience, and a deep understanding of the businesses he invests in. These are the strategies that have made him one of the wealthiest and most successful investors in the world. So, what exactly are these principles that Buffett so firmly believes in? Let's delve into the world of Buffett's investment strategies. Buffett's first principle is simple yet profound. Invest in what you understand. This might seem like common sense, but it's surprising how often this principle is overlooked in the rush to jump on the latest hot stock or trend. But not for Warren Buffett. He sticks to what he knows and understands. Let's take a closer look at some examples to illustrate this point. Take Coca-Cola, for instance. It's a company that produces a product which is simple to grasp. We all know what Coca-Cola is, we know what it tastes like, and we understand the business model. Sell fizzy drinks to the masses. Buffett saw the potential in this simplicity and invested in Coca-Cola back in 1988. Today, Berkshire Hathaway, Buffett's company, owns almost 10% of Coca-Cola. Then there's Geico. At first glance, insurance might not seem as straightforward as fizzy drinks. However, Buffett understood the business. He saw that Geico offered a product everyone needs, car insurance at a lower cost than competitors, creating a distinct advantage. Buffett started buying Geico shares in the 1950s, and by the late 90s, Berkshire Hathaway fully owned the company. There are numerous such examples that demonstrate Buffett's approach to investing. He doesn't invest in companies because they're trendy or because everyone else is. He invests in them because he understands their business model, he believes in their product, and he sees their potential for long-term success. And this is a lesson we can all take to heart. Before you invest your hard-earned money, make sure you understand the business you're investing in. Do your research. Ask questions. Don't just follow the crowd. Buffett's approach is not about chasing trends, but about solid understanding and belief in a company's potential. Now, let's move on to his second principle. If you have come this far, then it means you have a burning desire to make money. Watch till the end to attract abundance. Buffett's second principle is all about the margin of safety. This term is not as complex as it may sound. It simply refers to the difference between a company's intrinsic value, which is the actual worth of the company, and the current market price of its stock. Buffett aims to purchase a stock when its market price is significantly lower than its intrinsic value, thereby creating a margin of safety. The idea of the margin of safety was first introduced by Benjamin Graham, the father of value investing, and Buffett's mentor. It's a principle that creates a buffer against the uncertainties, the ups and downs of investing, and the unpredictability of the market. It's a safety net that reduces the risk of losing money on an investment. Now, how does Buffett utilize this principle? He's always on the lookout for companies that are undervalued by the market. These are businesses that have strong fundamentals, but for some reason, their stock prices are lower than they should be. This could be due to market fluctuations, temporary problems within the company, or even public sentiment. Buffett has used this principle time and time again in his investments. When the 2008 financial crisis hit, many investors were selling out of fear, but Buffett saw it as an opportunity. He invested billions in companies like Goldman Sachs and General Electric, whose stock prices had plummeted. He bought these stocks at a significant discount, creating a massive margin of safety. And when the economy recovered, these investments paid off significantly. The margin of safety principle is not about finding cheap stocks. It's about finding quality businesses that are currently undervalued by the market. It's about patience, discipline, and the ability to resist the herd mentality. With the margin of safety, Buffett ensures he's buying businesses at a discount. But there's more to his strategies. Let's explore his third principle. Buffett's third principle revolves around the power of long-term investing. This principle is as simple as it sounds, yet it's often overlooked in the rush for quick profits. Warren Buffett is a firm believer in the idea that time is indeed money. Let's look into this principle a little deeper. Buffett's belief in long-term investing stems from two key concepts: the magic of compounding interest and the inevitable growth of the market. The concept of compounding interest, or earning interest on your interest, becomes more powerful the longer you let it work its magic. Take an acorn, for example. Given enough time, this tiny seed will grow into a massive oak tree. The same goes for your investments. Small, consistent investments, given enough time, can grow into a substantial portfolio. Now let's talk about market growth. Over time, despite its ups and downs, the stock market has shown a consistent upward trend. This means that, in the long run, your investments are more likely to increase in value. By holding onto stocks for a long period, you're essentially betting on the overall growth of the economy. It's a bet Buffett has made time and time again, and it's paid off handsomely. For instance, consider Buffett's investments in American Express and Wells Fargo. Buffett didn't just buy these stocks and sell them at the next market high. No, he held onto them for decades. And these long-term holdings have been a significant contributor to his overall success. It's important to note that long-term investing isn't about blind patience. It's about having confidence in your choices and giving them the time they need to flourish. It's about resisting the temptation to jump ship at the first sign of trouble. It's about understanding that the market's short-term fluctuations are less important than its long-term progress. Patience and long-term vision, that's what Buffett's third principle is all about. Thank you for following through the video without distractions. This shows your commitment to success. Now let's talk about his last principle. Buffett's final principle is the circle of competence. This principle is all about self-awareness. It advocates understanding your own areas of expertise and staying within them when making investment decisions. The circle of competence isn't just about knowing what you know, it's equally about being aware of what you don't know. Let's delve deeper into this concept. Imagine a circle. Inside this circle is everything you know about a particular subject. This is your circle of competence. Outside this circle lies the vast ocean of knowledge you don't possess. When it comes to investing, Warren Buffett suggests staying firmly within your circle of competence. Buffett himself is a shining example of this principle in action. He sticks to industries and companies he understands thoroughly. For instance, he has famously avoided tech stocks for most of his career, not because they aren't profitable, but because they are outside his circle of competence. He once stated, "It's not a sin to miss a great opportunity outside one's area of competence, but inside, you have to grasp it." Of course, this doesn't mean that one should not learn about new industries or markets. On the contrary, Buffett encourages continual learning to expand your circle of competence. However, he cautions against making investment decisions based on limited understanding or trends. This principle underscores the importance of informed decision-making in investments. It's about knowing your strengths, acknowledging your weaknesses, and playing to your strengths. It is about avoiding the trap of the know-it-all and embracing the wisdom of the know-what-you-don't-know. It's about being patient and waiting for opportunities that fall within your circle of competence instead of chasing every hot tip or trend. By sticking to his circle of competence, Buffett avoids unnecessary risks, and that, in essence, is his investment philosophy. So, what can we learn from Warren Buffett's investment principles? Let's distill it down to the essentials. Buffett's approach is rooted in understanding. He makes it a point to invest in what he comprehends thoroughly, not just vaguely. This principle, combined with his emphasis on the margin of safety, ensures that his investments hold up even in turbulent times. Buffett's distinct style also illustrates the power of patience. He's a long-term investor, not swayed by short-term market fluctuations. This patience, coupled with his adherence to the circle of competence, sticking to industries and businesses he's well versed in, has been instrumental in his success. These principles are not just applicable to Buffett, but can be adopted by anyone looking to navigate the world of investing like you. If you follow these principles, you will attract abundance of wealth. The techniques are proven. As we wrap up, remember, understanding, safety, patience, and competence. These are the pillars of Warren Buffett's investment strategy, and they can be yours too. Thank you for watching.